Yes, so December 2023, question 4, it reads, the following financial statement was extracted from the accounting records of Budo Limited, a public limited company. So first of all, given the statement of financial position as at 31st of October 2023 and 2022. So we have the non-current assets, which include property, plant, and equipment. We have intangible assets. Below that, we have current assets, trade receivables, cash and cash equivalents. Then at the equity, we have ordinary share capital, revaluation surplus, retained earnings. Then you have the total equity. We have the non-current liabilities, which include long-term borrowing, deferred tax, and then we have the current liabilities, which include trade payables, current tax, interest payable, and then we have the total equity and liabilities. Then we have the statement of comprehensive income, where you have revenue, cost of sales, gross profit, distribution cost, admin expenses, profit from operation, finance cost, profit before tax. We have the income tax expense profit for the year, and then we have other comprehensive income, which include revaluation gain on property, and which is net of deferred tax. Then we have some additional information, number 1 up to note number 3. We are going to go through that particular information. And then what are we required to do? We are required to prepare a statement of cash flows for Budo Limited for the year which ended 31st of October 2023 using an indirect approach in accordance with International Accounting Standard number 7. So before we prepare a statement of cash flows, I want us to go through the additional information and we see, there are some workings which are required. So let's go through the additional information, starting from the additional information number 1, where we are told that property, plant, and equipment was made up as follows. So we are given the information about property, plant, and equipment, whereby we are given the values on 31st of October 2023, and actually that is the end of the current year, and then 31st of October 2022. 31st of October 2022 is the end of the previous year, and it's also important to note that the closing balance for previous year are the opening balances for the current year. So those figures we have for the year which ended 31st of October 2022, this will be the opening balance for the current year. So we have the costs or valuation, that should be cost or valuation. We have the accumulated depreciation, and then we have the carrying amount. Now, the carrying amount, this is the same with the net book value, and basically this is the value at which now the assets or the PPE are recorded in the statement of financial position. In fact, if we go up there, in our statement of financial position, specifically under the non-current asset, you will see we have the PPE, property, plant, and equipment. The value at the start of there was 113,600. At the end of there, it was 118,400. And basically, those are the figures we have in note 1 as the carrying amount. Then, in the second sentence of note 1, we are told, during the year which ended 31st of October 2023, the property was revalued upward for a gain of 1.2. So basically, that is a revaluation gain. So, and we know a revaluation gain, this one is debited in the PPE account, and then we credit that in an account called the revaluation reserve. Then you're told the company does not make any transfer to for excess depreciation upon review. However, it accounts for deferred tax on revaluation gain. The income tax rate applicable to Budo Limited is 30%, and then you're told the depreciation for property, plant, and equipment has been charged to the profit and loss. I think what we need to do as far as that information in paragraph 2 is given. Number 1 is to compute something called the deferred tax on the revaluation gain. So, and this, I think, something which is covered in the topic of income taxes. So let's compute the deferred tax. The deferred tax on revaluation gain. So how do we compute this one? So to compute this, we take the revaluation gain, and then we multiply this with the tax rate. So in paragraph 2 of that particular question, we are told that this particular company revalued a property upward with an amount of 1.2. Remember, If you go back to the income statement, the statement of financial position given at paragraph 1, you will see all figures are in thousands of shillings. In thousands of shillings means that the last 3 zeros have been omitted. So therefore, for us, we also need to be consistent here by also working with all figures in thousands of shillings. So any figure you are picking from the additional information, you have to omit the last 3 zeros. So like this figure, we will not take it as 1.2, but we take it as 1200. But we know we have omitted the last 3 zeros. Still, in paragraph 2 of note 1, we are given the tax rate, which is 30%. So therefore, this deferred tax on revaluation gain will be an amount of how much? Will be an amount of 360. Now, how do we account for this deferred tax on revaluation gain? So in terms of how we account for this amount here, that is the the deferred tax on revaluation gain, this one we debit it in the account called the revaluation reserve account. We debit this in an account called revaluation reserve account, and then we credit the deferred tax account. We credit the deferred tax what? The deferred tax account. In other terms, this particular amount of deferred tax on the revaluation gain, this one should reduce the revaluation gain. For example, this revaluation gain, when it is being recorded in the income statement at the other comprehensive income, because this should be recognized as part of other comprehensive income, the company will record this, but minus tax. So this will give us 840. So if you go back to the income statement which was prepared by this company, the income statement which was prepared by this company, I hope you can see that below the statement of financial position. Down there, below the profit for the year, I hope you can see the profit in the statement of comprehensive income. I hope you can see we have other comprehensive income, and where we are given the revaluation gain on property. Revaluation gain on property is this revaluation gain, but the amount which is recorded there is 840. And actually, you can see inside the bracket, we are told it is net of deferred tax. So which deferred tax? This one. So therefore, in terms of how this figure was arrived at, the company took 12 minus that to give us what? 840. Sasa, yes, it's very, very important for you to know how to account for this, because you will see when computing the tax paid, then we are going to capture this amount of 360 in the tax account. In the tax what? Account. Sasa, yes. But still, we will come back to that particular point in point number 1, because there are some accounts we need to prepare. But I think in fact, we can just prepare them before we go to note 2 and note 3. Here in note 1, we need to prepare 2 accounts. Which are those 2 accounts? Number 1, we need to prepare the PP account, and we prepare that account at cost. Why do we need to prepare that account? It's for us to determine, well, there are some items of PP which were acquired. And also we prepare another account called the accumulated depreciation account. That account is prepared to determine whether or basically to determine the depreciation for the current year. So can we prepare those 2 accounts here, even before we go to note 2 and note 3? So you prepare the first account, which is the property, plant, and equipment account. And this account, we are going to prepare it at cost. And number 3, we prepare the account called the accumulated depreciation account. This account, I've said, the reason why you're preparing it is to determine the depreciation for the current year. Sawa? Yes. So now, this particular account, we know these PPL assets. All assets, they have a debit opening balance. Remember, this is a debit. That is the credit side. So we record the PP at cost. Remember, we have said we are going to prepare this account at cost because we are preparing a separate accumulated depreciation account. So we are given the cost of the PP at the start of the year in note number 1. And I've said those figures which we have in the year which ended 31st of October 2022 will be the opening balances during the current year. Those were the closing balance in the previous year. During the current year, they are opening balances. So the cost of PP at the start, as per note number 1, is 126,200. Remember, I'm not preparing this account at carrying amount or at net book value. We are preparing this account at cost. So that is the opening balance on the debit side because that is an asset, and then the closing balance to be on this side. Still the cost of the PP at the end of the year. That one there. Sasa, then we record the opening balance in this account. So the accumulated depreciation, basically this is a provision account because depreciation is a provision. So all provisions account, they have a credit opening balance. So therefore, the opening balance in this account will be on the credit side. And we have the opening balances for accumulated depreciation in note number 1, which is 12,600. And then at the end of the year, the balance carried down now will be down here as balance carried down, a figure of what? A figure of 19,800. 19 what? 800. So remember I've said that the reason why you're preparing this particular account here is to determine how much was the depreciation for the current year on PP, because there is some information which are given in note 1, the last sentence. We are told depreciation on property, plant, and equipment has been charged to the profit and loss. But have we given that depreciation for the current year? No. We can only be able to determine that by preparing this particular account here. Sasa? Yes. So, but now in preparing this particular account, the PP account, it's important to know what affects the PP. Number 1, in case there were some PP which were disposed, or basically in other terms sold, you come and you credit them here. In case during the current year, the company revalued some items of PP and there was a revaluation loss, not a gain, there was a revaluation loss. Revaluation loss also reduces the value of the PP. Those are the 2 items which are credited in this account. What about on the debit side? So on the debit side, what we record on this side, what increases the value of the asset is the revaluation gain. And number 2, the acquisitions. Acquisitions, these are items of PP which were acquired. And actually, we have said this is one of the main reasons why preparing this account to determine the items of PP which might have been acquired during the current year. So what are we given in note number 1 as far as the PP are concerned? Number 1, we are given this revaluation gain. And this revaluation gain, we recorded here at 1,200. At 1,200. Though remember, we have said that when this amount was recognized in the income statement, it was recognized net of this tax. But you can see this amount of 360, there is nowhere it is affecting the PP account. That's why I'm saying we recorded here as the gross of 12. As the gross of 12. So basically what that means is that during this year, there was no loss. And equally, if you check in note 1 and also note 2 and also note 3, you'll be able to see that there was no disposal. There are no items of PP which were disposed. What does that mean, therefore? It means that we have to balance this account, and the balancing figure which will be here, it basically represents the items of PP which were acquired. So can we get that balancing figure there? And yes, let's compute that balancing figure. We take whatever you have on the credit side, which is 138. 200, what you have on the credit minus what you have on the debit, 126, 200 minus 1,200. So here I'm getting a balancing figure of 10,800. 10,800. I hope that is equally what you're getting. These are the items of property, plant, and equipment which were acquired during the current year. That is one of the items we need to have in our cash flow, or when preparing the statement of cash flow. Equally, in this case, we need to record this account, to balance this account. But before we balance it, you also have to, remember the objective of preparing this account, you have said, is to do what? To determine the depreciation for the current year, which was recognized in the income statement or in the statement of profit and loss. That should be the balancing figure here. But also you have to check whether there were some assets which were disposed. In case there were some assets which were disposed, the accumulated depreciation should be debited here. We know there was no item of PP which was disposed. It basically means that the balancing figure which will be on this side, it represents the depreciation for the current year, which we also need to have when preparing our statement of cash flows. So that is 19,800 minus what we have on the debit, and that is 72. That is 72. So this 72, this is the depreciation for the current year. That basically is one of the items which we, one of the figures which we need to have when preparing our statement of what? Cash flows. And I think in our case, we are done with point number 1. So can we move now to point number 2 and point number 3? So in point number 2 now, point number 2, what are we told? We are told that during the year which ended 31st of October 2023, Budo Limited acquired some new patent rights at a cost of 5 million. So a patent, how, what is this? When you're told a company acquired a patent, who can tell us what is a patent? A patent right. A patent right, who can tell us what is this? Brian, Minor, Gaspard, what do you mean by or what is an intangible, what is a patent right? Vincent, Sarah. Yes, so this is basically an intangible asset. This is an intangible asset. So therefore, anytime you're told a company acquired a patent right, this is an intangible asset. Yes, so we are told the company acquired an intangible asset of 5 million. And then you're told any amortization on intangible asset has been included in administrative expense. So you can see there was amortization, but are we given amortization? No. How do we compute this amortization? We can only compute this amortization by preparing the intangible asset account. The intangible asset account. So let's prepare intangible asset account. Intangible assets account. Intangible asset account. So where do we get the information for preparing this particular account? We have that information in the statement of financial position in the balance sheet of this company under the non-current assets. Under the non-current asset, we are given the intangible assets at the start of the year and also at the end. Take into account this is an asset account. The opening balance will be on the debit side. And I hope you can see the value for intangible asset at the start of the year. Remember, I've said those values we have in the year 2022 are the closing balance for the previous year, the opening balance in the current year. So the intangible asset at the start had a value of 23,680. The intangible asset at the end of the year had a value of 24,290. 24,290. And then what do we record in this account? So what should be recorded on this side are acquisition. Were there some intangible assets which were acquired? What we record on the credit side is, for example, disposal. Were there some intangible assets which were disposed? In our case, we know there were none. And then the other item which is also recorded on the credit side, because it reduces the value for intangible asset, is any amortization. And actually that is what we want to compute, because we know during the current year, per note number 2, the company acquired intangible asset which had a cost of 5 million, but we recorded 3,000 of shillings. So the balancing figure which will be on this side represent the amortization. The amortization is equivalent to depreciation, is amount which was written off in relation to the intangible asset, which should be recognized as an expense, but basically this is a non-cash item. So how much is the amortization, the balancing figure there? How much is the balancing figure? How much is the balancing figure here? The balancing figure here. I'm told it's 610. I don't think it is 610. Sauda, I think it can't be 610. So guys, I need to get these answers from you. I'm not getting answers. I'm not getting answers from you. You need to participate by giving me these answers. I've not gotten any answers from Vincent, from Sarah, from Moses. I need to get these answers. I need to get these answers. And this should not take us even 2 minutes. This is something we should just take you seconds. We should take you seconds in terms of computing that. So that will give us 4390. So that is what? That is basically the amortization. Amortization is an intangible asset. So therefore, we're going to adjust it to a profit because it was deducted in arriving at that. Okay. So then I think we are done there. We are done with that. So let's move to the last point of note number 3, and we are told the company repaid some borrowing which had matured during the year and also issued new roll notes amounting to 3 million. The company repaid some borrowing which had matured. Have we given those borrowing which had matured? No. Which were repaid? We are not given that, but also we are given the new loans. The new loans, these are like debt instruments which were issued by the company, which had a value of 3 million. So these affect what? These affect, if you go to where we have non-current liabilities, can you go to where we have non-current liabilities? We have something called long-term borrowing. So that long-term borrowing is now what is affected by note number 3. And therefore, we have to prepare that account because there is something which we need to compute, the long-term borrowing which were repaid. Let's prepare that account. That will be our working number 5. Long-term borrowing account. So first of all, we start by recording the opening balance. So the opening balance in this account, remember these are liabilities. All liabilities, they have a credit balance. Long-term borrowing at the start was 46.8, and the long-term borrowing at the end of the year was how much? Was 37,550. 37,550. So what should we record in this particular account? Number 1, and the new long-term borrowing by the company. So if the company borrowed some amount during the current year in terms of issuing some debt instrument and so on, that one, the amount received should be debited in the bank account and then credited in this account. So in note number 3, we are told that this company issued new loans. I've said these are like debt instruments which were issued. So those new loans which were issued, the amount received should be debited in the bank account and then credited in this account, 3,000. Then once the company repay some debts which have already matured, that one should be debited here and then credited in the bank. So I'm told what? Intangible assets. Intangible assets, that is a figure of 23,680. Brian, that is what you have recorded there. This 23. This 23,680. 23,680. Yes. So basically what I'm saying now, the balancing figure which will be here is the long-term debt which matured and which were repaid. So how much will be that figure? So let's balance this account. So this will give us 46,800 plus 3,000 minus what we have on the debit, that is 7,550. I'm getting 12,250. So these are the long-term debts which matured and basically which were repaid. So remember all this information, we need to have it in our cash flow. And I think we are done with the workings. So what we need to do is we go straight and prepare our statement of cash flows. So the name of this company is Budo Limited. Budo Limited. What are we preparing? The statement of cash flows. The statement of cash flows. So let me do this there because of the space here. So let's have our statement of cash flows here. The name of the company is Budo Limited. Budo Limited. This is the statement of cash flows, which is for the year which ended 31st of October 2023. October 2023, 31st of October 2023. Yes, and always what we know is that when preparing this statement of cash flows, we always start by getting the cash flows, the net cash flows from operating activities. Then from there we proceed and we determine the net cash flows from investing activities. And finally we determine the net cash flows from what? Financing. So therefore here we start by determining cash flow from operating activities. From operating activities, we also need to have two columns, and our figures are in thousands of shillings. Our figures are in thousands of shillings like that. Yes, our figures are in what? Are in thousand. So then you also have to remember in this particular question here, we are required to prepare this particular statement of cash flows using which method? The indirect method. So under the indirect method, we compute this particular cash flows from operating activities by adjusting the operating profit or the profit before interest and tax with a number of items. So this is what we start with, profit before interest and tax. In other terms, this is also known as operating profit, or like in our question here, it is the one which is referred to as the profit from operation. Profit from operation is the same with operating profit, is the same with the profit before interest and tax. Where do we get this? We get this from the income statement, which is given. The income statement, which we have below the statement of financial position. Can you tell me how much is the profit from operation? Profit from operation is how much? Profit from operation. Profit from operation is how much? Yes, that is a figure for 22,500. That is what we start with here. And the beauty with this particular question for cash flows is that anytime you come across a question for cash flow, there are always 3 marks. Like by recording that there, you already have 2 marks, because it is also important for you to note that any correct entry which you have in your statement of cash flows, you always get 2 marks. 2 marks. Any correct entry you have there. For example, you can see these are questions for how many marks? Are they 20? Yes, I think these are questions for 20 marks. So basically, for you to get those 20 marks, you don't have to get everything correct. You just need to have 10 correct entries. 10 correct entries here. Sasa? Yes, like by recording that profit before interest and tax, we already have how many marks? 2. And then we make some adjustment as far as this, as far as that profit is concerned. So here the number of adjustments which are made to that profit, a number of adjustments. And the first adjustment to our profit are the non-cash items. And there is always this acronym which is used by majority of the students to remember the non-cash items to be adjusted to that profit. So the acronym is 𝗙G. 𝗙G. D stands for depreciation, I stand for impairment loss on goodwill, A stands for amortization of intangible asset, L is the loss on disposal, G is the gain on disposal. So you check from the workings which we have, or basically from the additional information, what do we have? What do we have here? So from this account which I have prepared here, we have this depreciation on PP. So that is the first item we have there. Depreciation on property, plant, and equipment. How much is it? This figure which we computed there, 72. So why do we need to adjust that to our profit? Is because in arriving at this particular profit here of 22,500, the company had deducted this depreciation, but we know depreciation is a non-cash item. This was accounted for as an expense, but did it resulted to cash outflow? No. Add it back. Actually, these 4 items here, you add them back to the profit, because in arriving at that profit, they were deducted, but they do not give rise to cash outflow. So that is the first item, depreciation. So in this question, do we have impairment loss? Do we have impairment loss? A stands for impairment loss, and basically impairment loss, this is related to goodwill. Goodwill is one of the non-current assets. If you go back to the statement of financial position of this company didn't have any goodwill. So we don't have any impairment loss on goodwill. A, this one stands for amortization on intangible assets. Do we have amortization on intangible assets? Yes, we have it here. Remember this figure which we computed. So we add it back to our profit because it was deducted, and that is a non-cash item. So here L stands for loss on disposal, and this one stands for gain on disposal. You check, were there some items of property, plant, and equipment which were disposed? We said as per this account, there was no gain, there was no disposal of items of PP. So meaning, if there was no disposal of items of PP, it also means that we don't have any gain or loss on disposal. So, but those are some of the items which now you adjust to your what? To your profit there. To your profit there. Yes, and then equally in the income statement, you also need to check whether in arriving at this particular profit here, in arriving at that profit here, whether there was any investment income which was included. Because if the company, for example, received some investment income, that investment income usually is included in that profit, but that investment income is not from operating activities, or these are not an income from operating activities. Remember, in our case, what we want to determine here, we want to determine the net cash, or the net cash received by the company from operating activities. If you receive an investment income, for example, as a company, this is not an income you have received from the operating activities. This is an income you have received from the investment which you have undertaken. And therefore, if this one was included in our profit, what you do, you less it here. And then when computing the cash flow from investing activities, that's when you consider that income. So in our case, we don't have that investment income. So what we do, we get the net amount here, which is known as the cash flows before changes in working capital. Before changes in working capital, So give me this net amount there. Give me that net amount down there. The net amount down here will be how much? Gaspard, I don't think that figure can be correct. There is no way we have a decimal here. I don't think that figure can be correct. Yes, I'm not getting answers, guys. What is the problem? I'm not getting answers. If you don't give me the answers, we can't be able to move. I'm waiting for the answers. I think there are just 3 figures to be added there. And then you give me the answer. I think I've only gotten the answer from Brian. Maina, I've not gotten any answer from you. Maggie, Vincent. You just need to add 3 figures there, you get the answer. Yes, so I'm yes, I think I'm given a figure of 34 and 090. And then from there we proceed and we consider the changes in working capital. The changes in working capital. So here we consider 3 items of working capital. The 3 items of working capital which we consider here, you just need to remember that acronym, RIP. We consider receivables, inventory, and payables. And as far as those 3 items are concerned, you just need to determine, was there an increase or decrease during the current year? So can we go to where we have the current assets? Because receivable and inventory, those are items of current assets. Payable is an item of current liability. So under the current assets, the first item we have there is inventory. Inventory at the start of the year was 5760. At the end of the year, it was 5880. So that is an increase. So you come here and you say that we have during the current year, there was increase in the inventory. So how much is the increase in the inventory? Give me that figure. So the inventory increased with 120. Then you need to ask yourself, the increase or what causes the inventory to increase is because of purchases. So if you purchase, you purchase more inventory, then that automatically is a cash outflow. Being a cash outflow, recorded there as a negative. Recorded there as a negative. Yes. So then below that we have what? We have the trade receivables. Trade receivables, I can see at the start were 4290. At the end of the year, 4070. That is a decrease. A decrease in trade receivables. Decrease in trade receivables. How much is the decrease in trade receivables? From 4290 to 4070. Yes, that is a decrease of 220. What causes the receivables to reduce? Remember, receivables is the amount of money which a company expects to receive from the debtors or customers. If that decreases, it means that the debtors or customers cleared some of their debts. It is therefore cash inflow. You record it as a positive. Then finally, we consider the payables. Payables, this is something which we get from the statement of a financial position at the current liabilities. So the payables at the start of the year were 8200. At the end of the year, they were 78. That is still a decrease. That is a decrease in trade payables. So how much is the decrease there? How much is the decrease in payables? Decrease in payables, how much? The payables decreased or reduced with 400. So, and these payables, this is the amount of money which a company owe to the suppliers. So if that amount reduces, what makes it to reduce? That amount reduces because part of the money which was owed to the suppliers or creditors was cleared during the current year. So basically, if that was the case, then that is a cash outflow. That is a cash outflow. Yes. And anytime you come across a question for cash flow, these are always free marks. So can we get the net amount down here? Give me the net amount here so that then we can come here and we less 2 items. We less the interest or finance cost which was paid. And then we also less the tax which was paid. The tax paid. I'm told that this is a figure of 34 190, 190. So then after getting that amount, we come down here and we list two items, the interest or the finance cost paid and the tax paid. Now, for the interest, we can start with this one, interest or the finance cost which was paid. This one is computed by considering two items. We go to where we have the income statement, or basically from the income statement. From the income statement, we have we have what? We have now I'm given totally different figures. Now, which figure is correct? Which figure is correct? Is it the one here I'm given by Gaspard or the other figure now? And I'm not getting the answers from you. I'm not getting the answers. I'm not getting the answers from Akina Vincent, from Akina Maggie, from Moses. What is the problem? What is the problem? If you don't participate in class, then the class will become a little bit difficult because I'm not able to get the answers from you. I don't know whether we are together, you are lost. What is the problem? You need to participate by giving the answers. Now, this figure is what? I'm given totally different figures. I don't think addition can be a problem. I'm given a figure there of 1680. I'm given a figure of 33780. I'm given a figure of 3490. I don't think addition can be that difficult. Now, what is the correct answer here? Yes, Akina Moses, Akina Margaret, Akina Brian, are we together? Because I'm not getting any answers from you. I'm not even able to know which is the correct figure here. Okay, so that is 3,790. So then from there, we proceed, we determine these two items. So let's start with this one, the interest or the finance cost paid. So I've said here we consider two items. You go to where we have the current liabilities, you check, was there any accrued interest or was there any interest payable at the start and also at the end of the year? And then from there, still you consider the finance cost for the current financial year. First of all, let's go to where we have current liabilities. We check, do we have any accrued interest? Yes, we have accrued interest, or in other terms, we have interest payable under the current liabilities. So we use that in terms of computing the interest paid. How do we compute this interest paid? We take the accrued interest, or the interest which the company was supposed to pay at the start of the year, which in the statement of financial position is given as 48. That is the interest the company was supposed to pay at the start. And then we add the interest for the current financial year, which is in the income statement. And that is also what we refer as the finance cost. In the income statement, the finance cost for the current year was 38. So add the two, and then you less the interest payable at the end of the year, still under the current liabilities. Interest payable at the end of the year was 35. That is how you compute the interest which was paid or the finance cost paid. Interest payable at the start plus the finance cost or the interest for the current year from the income statement, and then minus the interest payable at the end of the year. That will give us interest paid of how much? That will give us interest paid of how much? Yes, I'm given a figure of 51. So then from there we proceed, we determine the tax paid. So for the tax paid, this one is determined by preparing the tax account. So for this one, we have to prepare the tax account because for tax, this has a number of components. So the tax paid. So in preparing this account, we go to where we have non-current and also current liabilities. You will see we are given something called deferred tax and the current tax. Record the opening balances there on the credit side. And then the same case, the deferred tax, the current tax at the end of the year. But we record those balances on the debit side down here. Then you also go to the income statement. You take the income tax for the current year, credited in this account, and then the balancing figure, which will be on this side, that represents the tax which was paid by the company. And that is now what we take to our statement of cash flows. So can we first of all record the opening and the closing balances for the deferred and the current tax? Where do we get this? The deferred is one of the components of non-current liabilities. Current tax is one of the components of current liabilities. So in the statement of financial position, specifically at the non-current liabilities, the deferred tax at the start of the year, I hope you can see that it was 70 at the start. Then at the end of the year, the deferred tax was 67.50. And then under the current liabilities, we have something called the current tax. So the current tax at the start of the year was 55.70. The current tax at the end of the year, it was 42.30. 42.30. That is the first thing you record. Then we go to the income statement. We take the tax for the current year. The income tax for the current year is 48.30. 48.30. Then what we do, we balance our account, which will be on the on this side, and that is now the tax which was paid. That is now what we come and take into account there. So how much is the tax which was paid here? We have 70.70 plus 55.70 plus 48.30 minus 67.50 minus 42.30. So I'm getting a tax paid here of 64.90. 64.90. 64.90. Someone to confirm whether that is correct. Nini? Yes, I'm waiting for the answers. I'm waiting for the answers. For the answer here. Brian, Maina, Gaspard, Vincent, give me the answers. Give me the answers so that give me the answer so that we move. We proceed. Is balancing a ledger account having any problem? Now, where are you getting 22? Why are you getting 22,200? Is the balancing figure 22,200? The balancing figure here, is it 22,200? Yes, the balancing figure, I don't think it is 22,200. So basically that is the tax which was paid. And what we do here is we determine the net cash flows from operating activities. The net cash flows from operating activities, this figure here, and that will be how much? That will be 33,790. 33,790 minus 5,100 minus 64,90. So which will give us 22,200. So that is it. Then from there we move and determine now we determine the cash flows from investing activities. Cash flows from investing activities. So investing activities, these are those activities which, or basically here what we consider generally are what? Are the assets which were acquired and basically the assets now which were disposed. Because investing activities, we said, is all about acquiring assets and disposing assets, acquiring and disposing assets. So from the workings which we have done here, I think we have been able to do that. From this account which we prepared, we were able to determine there are some items of property, plant, and equipment which were acquired here. So we come and we say that during the current year, there was acquisition of property, plant, and equipment. There was acquisition of property, plant, and equipment, which had a value of 10,800. And we know that this is a cash outflow. So recorded here as a negative. As a negative because it's a cash outflow. Then from this particular account, the intangible assets, also we determine, or basically we know from, I think, working additional information number 2, there was acquisition of intangible assets. So these are the patents which were acquired, which had a value of 5,000. Still, this is a cash outflow. That is a cash outflow. That is the other item which you consider here. The other item which you still consider here is disposal of assets. So in this particular question here, there was no any asset which was disposed. There was no any asset which was disposed, or in other terms, sold. So the other item you may also consider here is any investment income which was received. Any investment income which was received. Do we have any investment income which was received? No. So then what we do, we get the net amount, we take it to the last column. So the net amount here would be a total of 15,800, and which is basically a net cash outflow, Then finally, we determine the cash flows from financing activities. Cash flows from financing activities. And for the cash flow from financing activities, or basically all items which we include here, we get them from equity and non-current liability section of the statement of financial position. All the items which we include here, we get them from equity and the non-current liability section, because we said financing activities are those particular activities which by the end of the day affect the company's capital structure, affect the company's capital structure. And just give me like 2 minutes, and then we continue with this, like 2 minutes. Yes, so I think we can proceed. We can proceed. So what I've said is that all the items now which we include here, that is when determining the cash flow from financing activities, all of them we get them from equity, the non-current liability what section, equity non-current liability what section. And I think that basically what we need to do, we got where we have the equity section and the non-current liability section, we determine what to be included here. So first of all, at the equity, what do we have? We have the ordinary share capital. So the ordinary share capital to the start of there was 32, at the end 40. What causes the ordinary share capital of the company to increase? The shares which were issued. So therefore, we can say number one here, there was issue of ordinary shares. And basically the shares which were issued by the company is equal to the increase. The increase there is 8,000. So which automatically is a cash inflow. Recorded there as a positive. Below that we have what? Share premium. Share premium equally, you can see it increased from 26 to 3,000. What causes the share premium to increase is because the shares which were issued by the company, they were issued at a premium. And actually that increase in the share premium represents the amount of money received by the company in form of the share premium. So the increase is 400, which is still a cash what? Which is still a cash inflow. Then below that we have revaluation reserve. This revaluation reserve, we don't consider it here because this arises as a result of the company's devaluation of assets. So if we revalue an asset and there is a gain, for example, there was a gain of 840 net of tax. This is a non-cash item. So we don't consider that in the cash flow. Don't consider that here. So then from there we have the retained profit. Now that retained profit, or in other terms, the retained earnings, this one we use it in computing the dividends paid. Always. You have to remember that. Retained earnings, the retained profit, we use this to compute the dividends which were paid. How do we compute the dividends paid? We take the retained earnings at the start of the year, the retained profit at the start, which in our case is given as 42,400. I hope you're together here. Take the retained profit at the start, 42,400, and then to this add the profit for the year. Or in other terms, the profit after tax from the income statement. From the income statement, how much is the profit for the year? It is 13,870. I hope you can see that from the income statement. The profit for the year, 13,870. After adding the two items, we less the retained earnings at the end of the year, which is in the statement of financial position, 52,770. So whatever you get here are the dividends which were paid. Dividends which were paid. So therefore, that's how we compute the dividends paid using the retained earnings or the retained profit figure. So that will give us dividends paid of how much? Dividends paid of how much? Yes, I'm given a figure of 35. And once a company paid dividends, we know that these involve cash outflow. These are cash outflow, recorded there as a negative because it's a cash outflow. It's a cash outflow. So then from there we go to where we have the non-current liabilities because we are done with items of equity. We got where we have non-current liabilities. So under the non-current liabilities, we have two items there. Deferred tax, that one we don't consider that here because we have used the deferred tax in computing the tax paid. Deferred tax, we don't consider that here. So the only item we are going to consider is the long-term borrowing. And I hope you can remember there is an account we prepared as far as that is concerned, the long-term borrowing. So that is as far as the long-term borrowing are concerned, we have two items you're going to consider here. First of all, we have this repayment of long-term borrowing. Repayment of long-term borrowing. This amount here, 12,250. So once a company repay a long-term borrowing, that is involve cash outflow, and then we have these new loans which were issued. So we can talk of issue of new loans. Remember, you said loans is not necessarily a bank loan. Loans are things like loan stock, debentures, or both. So once the company issued this, the company received money, which is a cash inflow. That 3,000 we recorded as a negative. And actually, here we don't have anything to be included here. And I hope you can see where we have gotten all those items under equity and also under the non-current liability section. Can we get the net amount there? We have 8,000 plus 400 minus, that is 500 minus 12,250 plus 3,000. 3,000. I'm getting a net amount of 43,50, which is basically a negative. Yes. So then from there, we get something called the net changes in cash and cash equivalent. Net changes in cash and cash equivalent. So how do we get this? We get this by adding 3 items. The net cash flow from operating activities, that's why I'm having that figure there. So the net cash flow from investing activities, and then net cash flow from financing. So we add those 3 net cash flows. So from the net cash flow from operating is 2,200 minus 15,800. The net cash flow from investing minus the net cash flow from financing, 43,50. And that will give us a net amount here of 20,50. 20,50. So basically that's how we determine that. And then to this, we come and we add the cash and cash equivalent balance brought down. So the cash, this comprises of cash in hand, cash at bank, and then cash equivalent. These are short-term investment. But now, if you go back to this particular question here, specifically under the current assets, you can see we are given the cash and cash equivalent at the start and at the end. So mean that the cash and cash equivalent at the start is 4670. So that figure is already given. So after adding the 2, this and this, we get something known as the cash and cash equivalent balance carried down. Balance carried down, remember, is the balance at the end of the year. So this will give us what? 0, 2, 7, 6, 7. Will it give us that figure? There. It will give us a figure of what? Is it 7720? Because it should reconcile with what we have in our statement of financial position, this one. 6360. Inakuja ngapi? Adding those 2 figures, 6720. So it is not the same with this one. It's not the same. What do we omitted? Tumeacha nini? So what is the difference? Because it should reconcile with this one, which is given in the statement of financial position. Oh, so I can remember there is something you omitted here in this account for tax. This one, can you remember this figure here? This deferred tax on the revaluation gain. Yes, remember you say that this amount of 360, it should be credited in the deferred tax account. So this one was supposed to be here in the deferred tax account because we are recording opening and closing balance here for deferred tax. So we needed to record that there. So we have this deferred tax on revaluation gain, the figure of 360. So mean that this one will have to change. This one is the one which you're going to change. So the tax for the year from the income statement, this is the 40. Yes, so I think this is the figure which is wrong, the tax paid. The tax paid. the tax paid. The tax paid. So can you first of all give me the correct figure for tax paid? Because this is an item we omitted. So that figure you can just less 360. Or is it lessing on adding? It should be adding. Should be adding. It was how much? Give me the correct figure there. So the net changes in cash and cash equivalent have said we add the three cash flows. The net cash flow from operating, from investing, and from financing. Add all of them. Add all of them. Add all of them. You get the net changes in cash and cash equivalents. So I want the correct figure for tax. I don't think it will be 6850. Is that correct? I don't think so. It should instead increase. So we just add what we have on the credit here. We have 7070. 7070 plus the 5570 plus 360 plus the 4830 minus what we have on the debit, 6750 minus 4230. Oh, sir, that is correct now. So what you'll do, can you go back to your cash flow? You change the tax paid. It means that this figure here will change. The net changes in cash and cash equivalents. The net changes in cash and that is the cash flows. The net cash flows from operating activities. The correct figure will be what? You just change the figure for tax. You give me the correct figure for 21,840. Okay, so then we correct this one. We correct this one. We have 21,840 plus or minus this 15,800 minus this, which will give us 1690, and then we add this. We add the cash and cash equivalent at the start plus 4670. So that will give us 6360. 6360, and actually that should be reconciled with what we have there, with what we have there, with what we have there, with what we have there. Are you getting that? Are you getting that? Are you getting that? Is that what you're getting? Yes or no? Okay, so I think that is it. That's what was required as far as that question is concerned. And basically that's how we tackle this particular question for cash flows. Now, if you go through the past papers, you'll be able to see we have so many questions from this topic for cash flows. I think we have a question for August 2023. We also have in 2022, we also have a number of questions. From this topic of cash flows. And actually last sitting, there was no question on this. So equally expect that this is another area which is likely to be examined in August. In the exam which will be sitting for in August, I expect that you may come across a question from this particular from this particular topic of cash flow. So therefore, make sure as you revise, you try to perfect on this particular area. More specifically, anytime you come across a question for cash flow, can you try to identify some of the areas whereby you get 3 marks? Because I've said, like in this question which had the 20 marks, so I've said in terms of how such a question is marked, is that you need 10 correct entries. You don't have to get everything correct. Like you prepare your statement of cash flows and this reconcile. No, you don't have to do that. You just need to get 10 correct entries. So 10 correct entries, each entry you get how many marks? 2 marks. And then by the end of the day, you get a total of what? 20. So mean that even if, for example, you get like eight correct entries, just 8 ticks, it means that in that question you have 16 marks. 16 what? Marks. This is basically how you're able to pass these papers. This is some of these particular questions. You don't have to get everything what? Correct. Yes, you just need to know where do you get free marks anytime you come across a question for what? For cash flow. Yes, and I think for today we are going to stop at that point. And equally, you can also get the solution for some of these questions. I have a YouTube account whereby I've done most of these particular questions and uploaded them there. So if you go to YouTube, you can check for these. This is my YouTube account called JK Accountancy Tutorials. I have a number of questions which I've posted there for what? For these from this topic of what? Of cash flow. You can check out some of those particular videos. And actually, once you got there, make sure you support Mwalimu by subscribing that particular YouTube account. Sasa, yes. So JK Accountancy Tutorials, you'll be able to get solutions for most of these particular questions, including that's a question for August 2022, and also some questions from the sitting of 2022. So I think for today, we are going to stop at that point. Once we meet in our next class, we are going to revise on the topic of published financial statements, which is also a compulsory topic in the exam. Or actually, there is always a question coming from this particular topic here. So therefore, before we meet, can you revise this topic on your own? You go through that particular statement of cash flows, statement of that topic of the public financial statement, and actually you